Hi, dear all audiences and all speakers and panelists. It's already 3 p.m., so we will start the workshop right away. So good afternoon, everyone. Thank you for joining us at this online workshop themed in how to understand and prepare climate-related disclosures. So now we will start this exciting workshop immediately. Please make sure you have connected good and mute yourself and hear me soundly. So if you have any technical issues regarding connections and sounds, please double check your Zoom settings or feel free to send us your questions to us. So now this workshop will start right away. This online workshop is organized by the Hong Kong Green Finance Associations and especially supported by the Hong Kong Exchanges and Clearing Limited. I'm Joy, the co-chair of Hong Kong GFA Esg Integration and Disclosure Working Group, and also the vice general manager of the CSAP Environmental Consulting Group. So before we start the formal agenda of this workshop, let's see some related housekeeping rules of our workshop here. So first of all, this workshop will be recorded and live broadcasted on the YouTube simultaneously. Please remember to always mute yourself, mute your microphone as audiences. And if you have any technical issues, please use the chat functions. And please use the raise hands and Q&A functions for raising your questions regarding the panel discussions, as well as the training discussions. And last but not the least, please enjoy the workshop, and your feedback and comments on this workshop are highly appreciated for us. So now, let's have a look at the full agenda of this workshop today. The theme is to how to understand and prepare climate-related disclosures, and it will last for around 2 hours today, featuring with famous asset managers and also representative from the Hong Kong EX and our knowledge partners to provide the training sessions. So now, as I am also one of the speakers for the opening remark, please allow me to give some color and provide a backdrop of this workshop today. So as one of the hot talks recently, climate change has driven huge and continuously increasing attention from the global societies. This year is actually the first year we will start to examine the Paris Agreement effectiveness. And also just 3 days ago, President Xi actually also announced in the 75th UN Global Summit that China actually will make efforts to peak its carbon emissions by 2030. And also try to be carbon neutral by 2060. So this is the very first time that China publicly announced its carbon reduction targets in absolute figures instead of just intensity targets, which is very much ambitious as a joint developing country. So in fact, no matter in Europe or China, the climate-related development is rather top-down instead of bottom-up sometimes. So the focus on climate change also has already been extended from the government to global financial regulators and investors. So the root cause is that climate-related risks have not been properly priced into the financial risk system. So look at both globally and domestically, financial regulators have been continuously promoting relevant guidelines to emphasize climate-related risk. So in Hong Kong, with Hong Kong SFC Strategic Framework in Green Finance released in 2018, and the updated Hong Kong EX ESG guides for issuers came into effective in July this year, we can see the regulators have put a further emphasis on this hit topic by adding climate change related requirements to listed companies. And similarly, the Hong Kong regulators are now looking at developing mandatory climate-related guidelines to all asset managers, covering from ESG governance, risk management, investment process, and also product disclosures. So at the same time, in other jurisdictions, we have also seen similar regulatory requirements on financial institutions taking effective, including like EU and mainland China. Recently, we also heard that from Shenzhen government and PBOC branch had requested all financial institutions in Shenzhen to mandatorily report their environmental and climate-related information, as well as conduction of stress testing and scenario analysis related to climate change. So as such, it's essential to better prepare corporates for the new regulatory requirements and further understand the expectations from investors, as well as provide capacity buildings on how to identify and manage climate-related risk. So therefore, this time, Hong Kong GFA joins hands together with Hong Kong EX, asset managers, and service providers to share their insights and provide in-depth trainings to all relevant stakeholders. So now, please join me together and welcome our first speaker, Kelly Lee, Vice President, Policy and Secretarial Service Unit, Listing Division, Hong Kong Exchanges and Clearing Limited, to give an opening remark on behalf of Hong Kong EX. Kelly, the floor is yours.
Thank you, Joy. Good afternoon, ladies and gentlemen. It's a pleasure for me to be here today. This topic, climate-related disclosures, is really what the exchanges has been focusing on in the past few years. 20 years ago, investors may have made their investment decisions largely based on the company's financial track record. Investors nowadays are becoming more increasingly aware that the financial statements alone are not necessarily enough for them to appraise the performance of the company. They start to believe that the companies that identify and address ESG risk are likely to deliver greater shareholder value at lower risk in the long term. Assessing a company's ESG risk is a necessary tool for risk management that can avoid billions or even trillions of losses. In the traditional business community, risk was simply an abbreviation of economic risk. This perception has now been changed. It has been recognized that all types of risk, in fact, intertwine with each other, and climate risks can affect companies' profit if not being managed properly. In a report published by the World Economic Forum earlier this year, it appears that the top 3 risks in 2019 in terms of likelihood were all climate-related risks. These 3 risks were also ranked top 5 in terms of impact. Compared with 10 years ago, climate-related risks could not have any place in the top 5. So this trend, in fact, marked a dramatic shift of risk that are threatening the business environment in which companies are operating in. And it is important to bear in mind that these ESG risks will eventually translate into real financial impact, and managing these risks properly can engender investor confidence in the long term in light of the future success for the company. In this area, the establishment of the Task Force on Climate-Related Financial Disclosures, TCFD, was one of the most significant developments globally. TCFD's recommendations focus on how climate change could affect businesses and make recommendations in relation to these disclosures. These has been widely accepted by most regulators internationally, as well as and in Hong Kong, the HKEX, the SFC, and the HKMA are also official supporters to this TCFD's framework. Our duty at the exchange is to ensure an orderly, fair, and informed market. An informed market calls for both financial and non-financial information. And that's the reason why we introduced the ESG reporting guide back in 2013. The development of ESG is an evolutionary process, and we evaluate our framework from time to time. Since 2016, all listed companies in Hong Kong are required to publish the ESG reports on an annual basis. And last year, we conducted another round of consultation and introduced certain new changes to our ESG framework to further enhance it. In light of the global focus on climate change and TCFD's recommendations, we hope to put climate change risk on our issuers' agenda, and therefore we require additional disclosure from issuers on climate change risks and how they manage these risks. We also require issuers to set target in respect of certain environmental KPIs so that they can keep monitoring and scrutinize their existing process to see whether they remain effective. Enough said for me. I hope through today's workshop, you can have a better understanding on how to assess, mitigate, and report on climate risk affecting your companies. Thank you, Joy.
Thank you, Kelly, for the kind opening remark and provide your insightful opening remark to us. And now we will right to start our session 2 about the workshop part. So let me try to go to the next page. Okay, thank you. So a panel discussions on why ESG and climate-related disclosures matters and its application scenarios for investors will be conducted now. So all panelists, please kindly ensure your camera is on and unmute yourselves. Thank you. Okay, please allow me to introduce briefly about my guest panelists first. So the first one is Gabriel. He is the head of Stewardship Asia Pacific, BNP Paribas Asset Management. And we have Ianku. He's the Senior Sustainability Analyst, Investment Stewardship Team, Legal and General Investment Management. Thanks, Ianku, to join us from London at the very early morning now. And also, we also have Catherine Han. She is the Head of ESG Research, Harvest Fund Management, joining us from mainland China now. And we also have Kelly. Yeah, we have Kelly, which already gave the opening remark. She's the Vice President, Policy and Secretarial Service Unit, Listing Divisions, Hong Kong Exchanges and Clearing Limited. And we also have Mary. She's the Head of Advocacy, Asia Pacific of CFA Institute. It's great to have you all to joining our panel discussions today. I believe it will be an interesting dialogue to bring valuable insights to our audiences. So already with the backdrop that more stringent climate-related regulations on asset managers is approaching and responsible investment mandates keep scaling up, we have seen increased demand from investors on corporate ESG disclosures. From the previous opening remark by Kelly, we also see that asset managers can be keen to better understand the climate-related risks and opportunities from the corporates. So now, please let me firstly start the discussions from our panelists coming from the asset managers here. So lady first, maybe Catherine. As Harvest is one of the pioneers in China to practice ESG investment, as well as recently launching your ESG scoring system of Asia-listed companies. Can you share with us a bit for local investors? How does climate change impact corporate investment values? And how do you act on climate-related investment risk and opportunities? Thank you.
Firstly, thanks for having me. Good afternoon, everyone. I'm Catherine Han from Harvest. I think for this question, I'd like to start with offering a thematic investment point of view. Because I think this would be quite straightforward and vivid example to understand or to let you know how we actually act on climate-related investment risks and opportunities. So at Harvest, we launched a low carbon and environmental protection fund, which invests about 80% or more assets in industries and sectors that are contributing to the low carbon economic transition and environmental protection. So by that description, you can see that it should be a low carbon thematic fund. But that fund was actually launched in December 2015. And back then, we actually faced even more difficult situation in research than today, because first of all, you can imagine that we don't really see many companies disclosing their carbon-related information, not even strategies or management policies and so on. So it's quite challenging for us to understand the carbon reality for different industries and companies. So back then, the strategy has been focused on, or has been quite narrowly focused on some industries. For example, EV, electric vehicles, renewable energies, environmental protection equipment or projects, something like that, like those. I think, in fact, many low carbon themed funds still took that sector-based screening criteria approach. But now I think with the research and engagement support from our dedicated ESG research team, along with the improved climate change disclosure among companies, the portfolio manager for that fund actually has been able to confidently broaden into more granular industries and business models that could serve the low carbon transition journey. For example, now he is investing more in semiconductors business for use in smart grid or use in smart cities projects. For example, EV batteries technologies, others like engineering services and software that help reduce carbon intensity across all sectors. So you can see that actually our knowledge or our technology know-how about climate issues has been expanding. But I'd like to expand this relatively narrow perspective to a more broader setting where we are actually more focused on systematic integration of ESG factors, including, of course, climate change, into our entire investment process. From an ESG integration point of view, I think this is actually the key, or more important, since the impact and the capacity building will be carried throughout the entire investment decision-making and affecting every investment professionals and within our company. In this journey, I think we want to really factor in the material ESG risks and opportunities in a forward-looking way. Within our framework, actually climate change is at the core of environmental issues because it is actually the arranging of a lot of other environmental issues like biodiversity, land use, natural resources use, and so on. So we think that it does not only present imminent risks for carbon-intensive sectors like oil and gas, coal-fired power generation, metals and mining, etc. But we think it is actually a long-term issue that would have very profound impact across all sectors. So especially, I think everybody has heard on this Tuesday that President Xi has announced the goal to achieve carbon neutrality by 2060 for the first time. I think this sends a very strong policy signal, and we can anticipate more forceful carbon reduction measures and policies across sectors. I think this would definitely have a big push on the climate agenda and awareness raising activities. But I'd like to reiterate the biggest challenge we face in this market when it comes to climate related investment decision making, which is definitely the low disclosure from companies at the moment, especially on quantifiable and comparable performance metrics like the carbon emissions and so on. Of course, we have seen that regulators have been pushing for disclosure requirements and guidelines. And this year we saw about over 120 A-shares companies actually disclose their carbon emissions data, which is much better or higher ratio than 5 years ago. But still, if you look at the ratio, it's still at just about 2.8 something % of the entire market. I think the disclosure ratio in the Hong Kong market would be much higher, but our own experience in looking into the H-share companies in terms of their climate disclosure has been that it is still very inconsistent and not very comparable, for example, in the reporting scope and the reporting format. So we are actually hoping that the first step for Chinese companies is really to begin disclosure meaningful and high quality emissions data and climate related policies. That's my take. Sorry for taking so long.
It's okay. Thank you very much, Catherine, for sharing with us your first round, thoughts about how the climate-related disclosures are important, as well as further strengthening the positive political directions from the highest top down in China. And we also heard from you, even though you are actually looking at this kind of data, but actually no matter it's for A share or H share, there's still some questions, still some problems existing, especially related to quantifiable and compatible data to be looked at and analyzed at. So now we will turn to Gabriel and Yanku. I know both of you are from very leading asset managers globally in sustainable investing for equity investment with various strategies. So what is your overall approach of ESG integrations? Why and how do you apply issues, climate-related disclosures in investment decision-making process? Can you share with us a little bit more on this direction? And maybe we can start from Gabriel first.
Cheers, thanks a lot. And thanks for the opportunity to share some of our experiences at BNP Paribas Asset Management. For us, I think I'm going to echo a lot of Catherine's comments, and I usually find myself agreeing with her, so this is nothing new. But what we typically find at BNP Paribas Asset Management is that the problem is around data availability, and without data, we can't make informed decisions. And so what we're trying to do is really evaluate the risks and opportunities that relate to our investment companies, and it can be challenging to do that without the right tools. The way that we approach ESG integration and trying to seek these types of insights at BNP Paribas Asset Management is through 5 different lenses. So the first is fundamental ESG integration. So this is a combination of a quantitative and qualitative approach in order to actually try and address and identify the most material issues driving each individual sector. Within that, climate change issues and carbon intensity are clearly key issues that we're looking at to try and identify and evaluate how well a company might be positioned relative to their peers. The second element that we look at is investment stewardship. And in this pillar, we're really trying to do 2 things. One is to learn more about what our portfolio companies are actually doing. And the second is to try and influence them and have a positive impact on their performance. And so this can be through partnering to enhance disclosures or to encourage adoption of best practice, or even to become more proactive in communicating the good work that's already been done within the company. The third pillar of what we do is around responsible business conduct. And this relates to identifying business practices that we believe are inconsistent with our investment values and excluding them from our investment universe. Typically, we prefer to engage with companies rather than exclude. So this is typically only 2 to 3% of companies within a benchmark. The fourth pillar is around our thematic areas of focus. And this includes the energy transition, environmental sustainability, and equality and inclusive growth. And so you can see from that climate change and climate-related disclosures fit heavily into both the integration, but also into the way that we're actually trying to think and build thematic products. And the final area is around what we call enhanced ESG. So this is essentially going beyond what we believe are minimum requirements to be a sustainable investor and looking at targeting areas such as dedicated thematic funds, such as an energy transition fund, an environmental absolute return fund, all of these sorts of products. Again, in order to have these products and in order to do screening, we rely on high quality data. And for issuers, this is a really interesting point, because if you don't tell your climate change story or your sustainability story, a data provider will do it for you. If we look at some of the key data providers out there, I think of the 15,000 companies we have data for, less than 1,000 are actually reported by the company. The rest are estimates from the provider. So not reporting anything doesn't mean that the numbers aren't in the market, but it means that they could be inaccurate and you could be being unfairly screened or placed into a category which doesn't represent your underlying performance. So for us, that's how we try and think about it and why we think ESG integration and climate change data is such a critical component of our process.
Thank you, Gabriel. I think it's very thorough to see you have 5 lenses to look at, ESG and climate-related disclosures or performance of the issuers or companies. And I also definitely agree with you. Even though the issuers actually don't report, but still there are lots of data available in the market, which is maybe not accurate, and also may lead them to be screened out by your 5 lenses, right? So it won't be that good for them to avoid disclosings in the futures. So thank you for that. And next, maybe Yanku, can you also share with us your view as well?
Sure, thank you very much, Joy. And good afternoon, everyone. I'm Yanku Daramush. For those who do not know Elgin, we're one of the world's largest asset managers. We work globally and manage around $1.5 trillion in assets. And I'll start with your question around why it is that we do ESG integration. We'll look at climate change and then talk a little bit about how. So the short answer is, of course, because this matters, or in the jargon terms, it's financially material. And I'll give one example. There are currently around $10 trillion in listed energy companies. This is a lot of money, and this is exactly the sector that is at the forefront, potentially the most vulnerable in the energy transition and climate change. So obviously we think about this from the perspective of there being risks in the market that we want to try and manage for our clients. What I mean by this vulnerability, we've done some modeling around different climate change scenarios. So think of a scenario where oil demand goes in a business as usual trajectory, and think of one where policymakers start to put in place more ambitious goals, like we've just heard from President Xi, where technology speeds up. What happens between these two scenarios just for oil? Well, the difference in 20, 30 years now is as large as the oil market is today. So think about this. One of the world's most important commodities, the window of uncertainty it faces is absolutely huge. One could argue maybe unprecedented. So it matters how we think about this. And it's importantly, it is around financial materiality as opposed to, doing good, polar bears, important as they might be. And this is not just about the future. For a long, long time, you start to hear from oil companies dismiss the idea that there is such a thing as stranded assets. They can always manage the risk, it's fine. Now you're starting to see some of the largest companies in the world writing down assets, saying they will no longer explore certain areas of the world, canceling projects. We've had around 90 billion of write-downs in this year alone in the oil and gas sector. So clearly there's a lot happening and investors need to be aware of that. That is the why we do it. The how we do it, I'd like to say there isn't a one-size-fits-all approach. So if you think about actively managed funds, you're trying to get an investment edge, you're trying to compare companies against each other, and there are a lot of tools and data frameworks that we apply to do that in a sector-specific way. Now, think about the other side of the coin, index funds, where you own to some degree the entire market, and that's a lot of the work that Elgin does in these index funds. There, you're less concerned about this company versus that company, which is the best oil company, the best automaker, but you're very concerned about risks which affect the entire market. How is every company managing or meeting the minimum standards? And that's a slightly different mindset. And in those areas where we try to construct index products, we try to bring into account the minimum standards across the entire market. And that is doubled up with our stewardship efforts, our engagements with the company. A lot of the time, you don't have the option to sell the company. So how do you apply public pressure? Through your engagements, or through speaking to regulators, or through teaming up with other investors. All those are very important elements in the toolkit. Now, I say no one size fits all, but I'm not trying to say, we're not doing anything, it's all vague. Actually, we are doing quite a lot. And the use of climate information leads to tangible investment and voting action. So we have and will continue to vote against companies for insufficient climate disclosures or insufficiently ambitious climate change targets. There are certain companies in the market whose stature influences the entire sector. We go to them and we say, collectively left unaddressed, climate risk poses a challenge to our clients' assets. We expect more of you and we will vote against you. And we have voted against you where that is not the case. We will vote against companies and we will divest as well from certain companies, from certain funds where we see insufficiently ambitious disclosures and targets. So, and I would argue that the use of climate disclosure is growing within investors. It is leading to investment decisions. It is starting to affect companies' cost of capital ultimately, and starting to direct the financing that goes to companies. That will be, I think, by way of an opening statement. Why we do it, because it's material. How we do it, it varies, but it is systematically applied across asset classes, and we are taking action on climate risks.
Thank you very much, Yanku, for this great introductions on your approach in LGIM to look at this kind of companies and in different scenarios, like either it's active management or it's index funds. How do you do that? And it's very strong signal from you to tell the corporates issues here maybe today is that you may go to vote against them or actually divest from them, right? So it's very good signals to be pushed here. Thank you very much for that. So now, maybe after hearing the thoughts from the very leading asset managers in sustainable investments here, I would also like to extend my questions to Mary. As we see the increasing demand from investors on issuers' ESG and climate-related disclosures to fulfill their internal risk management and investment assessment procedures, we also learned that the newly released consultation on the ESG disclosure guideline for investment products from CFA Institute as a leading financial institution globally. Can you share with us a bit on the background of this consultation and its implications to issuers' ESG disclosures? Mary, please.
Thank you, Joy. Really appreciate the opportunity, and thank you for your question about our ongoing consultation about this new ESG disclosure standard. And I think when I talk about a new ESG disclosure standard, I can almost hear the collective groan from the audience and from everyone on the panel. Why do we need another standard? And do we, don't we have enough rules and regulations as it is? So so let me explain, okay? So one of the first things that we did when we embarked on this project was actually to research all the standards and regulations that are already out there, not just in Asia Pacific, of course, but globally, regionally, in market, those that are national regulations and those that are voluntary and those that are somewhere in between. And the reason is, of course, we didn't want our effort to be duplicative. We don't want to add to the confusion. And we came up with a very long list, and it was by no means exhaustive. But after analyzing the efforts that appear on our list and having had direct conversations with a lot of organizations that drove those standards, we felt that there was still a place for CFA Institute to contribute, and that was in establishing specifications for product disclosures. Okay, so the standards that are being consulted are disclosure is a disclosure standard for investment products. So let me expand a little bit. So what we're envisaging is to set up a global and voluntary standard that will apply to investment products. They won't apply to issuers. So if you're an issuer on the call, then but it will affect you, and I'll go into that a little bit later. What we're envisaging is a descriptive standard. It will be that will allow asset managers to describe the ESG related features of their products. And we envisage that this standard will be helpful not just to institutional investors, but also retail investors, asset managers, consultants, and other advisors who are sitting between their end clients and the product manufacturers. What we are aiming to do is to allow investors to help them better identify and compare products that most, and select the products that most suit the needs. And so it's our intention to help define and classify ESG related features and establish disclosure requirements and procedures for independent testing. So what this standard is not is an issuer disclosure standard. So we're not trying to add to the, for example, the requirements that maybe Stock Exchange of Hong Kong already has, or other global reporting frameworks such as Tcfd or GI. So we're not like, this is not a standard like that. We're also not trying to define what ESG is, because we recognize that ESG may mean different things to different people. But what we're trying to do is to come up with a language or to allow asset managers who claim that their products have certain ESG benefits to explain a certain way, to disclose certain information, how that benefit comes about and how they're going about it, so that investors can make their decisions. What does that mean for issuers? Now, if we step back a little bit, we're all in the same ecosystem. We're all in different parts of the value chain. By adopting a standard like this, asset managers actually have a kind of a level playing field, because the sort of disclosures that that they're making would be comparable. And therefore, and for example, if they say that their product is a best-in-class product, and they're looking at diversity, or they're looking at decarbonization or gas emissions, they will be looking at different disclosure data points from companies. And the better the disclosures are from a company, the higher quality that those disclosures are, the easier it is for that asset manager to find you and to put that issuer into their product. And in that sense, capital will be more efficiently allocated. So we see this as a win-win-win situation. In terms of time frame, so we've got a paper out there that's a consultation paper out there about the standard. It's a very conceptual piece right now. We are hoping to get as much feedback as possible globally and obviously in Asia Pacific. The consultation period closes in mid-October, after which we'll be working through some of the feedback, and we are expecting to issue an exposure draft next year, and with the aim that the standard will be available from late 2021 onwards. Thank you, Joy.
Thank you, Mary, for this kind sharing. And I definitely agree that because actually currently, the Hong Kong local regulators are also looking at relevant, product disclosure guidelines for the asset managers to work on their ESG relevant or labeled funds. So it will be very important if we can have this kind of disclosure suggestions from like CFA, which is, could help to educate no matter only just the institutional investors, but more importantly, also the real retail investors as well. So we do encourage all, participants here, maybe you can also go to give your comments and to answer the consultation papers provided by CFA Institute. Okay, so thank you again, Mary, for sharing with us. Then we will come back to Kelly again. So while growing number of investors recognize that climate-related risks present financial, operational, and compliance risks to companies, and yet, many companies believe that additional reporting requirements do not justify the cost of disclosure and mitigation efforts. As a listing platform, how does Hong Kong EX perceive corporate challenges in the process of enhancing ESG reporting, and what are the suggested solutions from your side? Thank you.
Thank you, Joy. I think what we see is a major challenge is to get the companies buy-in. By the companies, I mean the board's buy-in to appreciate the true value or the true benefits of integrating ESG risk into their strategy. And we think this will not be possible if the companies or the board merely treat ESG reporting as a data collection or data regurgitation exercise without the board involvement. From our review of the issuer's ESG disclosure, we observed that there was a general lack of details in respect of the board's involvement in the whole ESG reporting process. And also there was little discussions on how, on what the board's thinking process is and what their explanation on how those ESG risks are related to their business. The board's involvement in the ESG reporting process is crucial because it will enable the board to better understand the company, and this will facilitate better integration of ESG factors into their business strategies. In fact, board involvement and also governance of ESG issues are the emphasis of some international ESG standards. For example, when we talk about Tcfd's framework on climate-related disclosures, it was a primary focus for in the framework on the board's governance on climate issues. That's why we try to tackle this challenge by introducing new requirements in our latest new requirements in the ESG guide. We try to take ESG issues to the board level and try to correct the board's perception that ESG reporting is just a compliance exercise. Actually, the board is the ultimate decision-making body of the company. They have to seriously consider the ESG risks that the company is facing and monitor the progress and how to and see how they could mitigate such risks. And apart from board's governance, another challenge we will see is still around materiality assessment. I think everyone would know that materiality is fundamental to a meaningful ESG reporting. From our review of issuers' disclosures, we still find that some issuers still did not report on whether they had conducted materiality assessment. And some said that they did that, but there was not enough details on how they identify such ESG issues that are material to them, or they either, and some of them also omitted to explain how the thinking process in reaching the conclusions of what issues are material. And given this, I would want to focus that because our ESG guide covers a wide range of ESG matters, and we would have assumed that not every single issue will be relevant to all of our issuers, given that we have over 2,000 issuers on listed on the exchange. And therefore, we would expect the issuers need to seriously consider what issues are material to them. And if some issues are not material, they should explain instead of making an irrelevant disclosures. And again, we try to tackle this problem by introducing some new requirements this year. And we want to highlight that assessing materiality is a key to a meaningful and concise ESG reporting. And we therefore require issuers to report on the whole assessment process, from the identification of ESG material ESG issues to explaining the criteria for selection of material ESG factors. Thank you.
Thank you, Kelly, for sharing with us, the most two important points. One is the, board engagement and also the materiality assessment. I believe both of these two are actually already the mandatory requirements, right, from the new ESG guidelines since this year. So yeah, it's quite important for all issuers to look at this. And sometimes I also heard that many corporates will ask, what's the expectation from asset managers? What should I report in the ESG report? And the asset managers will say, you are the board of this company, so you should be more, aware of the important material issues of your single company. So you should tell me what's exactly the materiality assessment of your company, and then you should look at the important ones to, address this in your reporting externally. So that's a very important piece of work to be done. So now we have listened to the first round discussions among all our panelists on what is climate-related risk of issuers and how it may affect the evaluations of the issuers, and also how they actually analyze and apply this kind of information of issuers. So now I would like to dig into more details and further questions, as I believe most of the audiences want to hear more from you as well. So I will also still start from our asset managers here to Catherine, Gabriel, and Yanku. Would you all please share with us, from your standpoint, as we have been talking about increasing expectations from both investors and regulators on asset managers to address the climate issues, what are your expectations from the corporates, in detail to address the climate-related risks and respective disclosures? And in the meantime, are there any challenges you're facing? Please also feel free to share with us from your company engagement experiences, because I see also both Gabriel and Yanku mention about the engagement part, right? So please share with us, and maybe we can still start from Catherine, lady first.
Thanks. I think company engagement is quite an essential step at Harvest too, to understand the exposure to climate-related risk and opportunity faced by our investee companies, because very often that could be the only channel for us to understand the issue at the company level. we think actually, so for engagement, our goals and approach can be very very similar to what Gabriel just described. So we joined the Climate Action 100 Plus last year, and have been participating in collaborative engagement efforts and meetings with some key companies along the way. But on top of that, we're thinking to initiate a formal climate change engagement program internally with our investment teams to help raise awareness and build capacity among our key holdings. This would be a key step for us to unlock or improve the quality of our investment value. I quite agree with Gabriel on taking a partnership approach with the company to help them along the way. But I think there should be a few key steps, and periodical reviews of the progress should be taken along this journey. So for us, we typically kick off a engagement journey with our investee companies, starting from raising management awareness and encouraging climate-related disclosure. Then we gradually advance to the next level, where we help to provide technical support and tools for a company to streamline their reporting process and to identify areas for improvement. For that part, we typically would recommend Tcfd Framework, and on top of the local disclosure requirements and framework and so on. We think TCF offers a more consistent and comprehensive approach, and the same language to communicate on the issues on the global peers. So TCFD is definitely what we would recommend. Then when investee companies are typically equipped with necessary tools and technology or technical know-hows, our engagement efforts could be advanced to the next level, where we focus on systematically adapting or help the company to adapt the business strategies, management responsibilities and process, as well as their product portfolios to effectively address long-term climate risk and opportunities. So our aim would be eventually influence the company behavior in an active way, because in this market, which is still quite alpha driven currently, the exclusion approach, where investors divest from particular sector completely and passively, is very hard to be carried out. So active engagement through partnership is the main approach we would take. I think this is also beneficial for us to improve the long-term value of investee companies and therefore the quality of our investment returns. I think there's a lot to be done, and we're just at the beginning of the journey. I would hope that companies, investors, regulators should come together more often to discuss and push the agenda forward together. So yeah, I'll pass to other colleagues on this topic. Thanks.
Thank you, Catherine. Maybe Gabriel, you can go on.
Sure, thanks. I think that I'd just like to build on some of the comments that Kelly actually made as well, because one area I want to focus as being of critical importance is around the concept of governance. So it's not just reporting data, it's actually strategic engagement with that data that leads to mitigation of risks and management of risks. And so I think that this also comes to Catherine's point around the first step of an engagement can be around fostering disclosure and maybe potentially working towards setting targets as part of a deeper strategic engagement. But that really what we're trying to do as investors through a lot of engagements is to work with the investee company to improve underlying performance and management and identification of these types of issues. So this is typically not a short-term project. We're all long-term investors on the call. And so I think that what it typically means is that we can go through companies on a journey. And importantly, this isn't just about only trying to pick companies that are already great and taking them to the next level. It's also trying to look at companies where we're looking at willingness of a company to shift and to adjust. And so that's typically how our philosophy is around structured engagement on climate change issues or on disclosure and engagement. I'd just like to circle back to the point of governance and why this is so important. And as asset managers, we're not trying to get companies to disclose so that we can have another data point to put into our model and just have a complete picture of data. It's all about what that data tells us about how the company is moving, the strategy of the company, the engagement with senior management on these issues. So for us, climate change disclosure, it's actually really interesting, not only what's being disclosed, but the path to reach that disclosure. How is the company thinking about the issues? At what level of the company are the discussions happening? And how is the strategy being implemented and who's been involved in those discussions? And for me, this is one of the things that I often find can be challenging or confusing for some issuers' perspectives. Because of the raft of disclosure requirements, there can be a mindset that this is a compliance-driven exercise as opposed to a strategic exercise. And that's one thing that we definitely try and address through our discussions. The other problem can be that I often hear pushback from investee companies that we're engaging with that scenario analysis is too difficult to do because no one knows what the world will look like in 20, 30, 40, 50 years from now. So there's no way they can do the numbers. And what I always say back is that I'm not actually interested in whether you've got the right number for 2050. I'm sure no one has the right numbers. I look at my 2020 forecasts that I made 10 years ago and they were horrible. So I don't think anyone really expects companies to have a crystal ball on this topic. But a lot of these issues, if the company starts to move early and try and position themselves, there is a lot of opportunity to address and mitigate these risks and to shift the strategy of the company. And that's really what we're trying to address through a lot of our engagement and a lot of our focus on these topics. So I'll leave it there, but I just wanted to highlight that important point around governance and strategic engagement.
Thank you for both Catherine and Gabriel here. Maybe you don't share too much now. I'll just pass to Iancu to share your views as well first.
Thank you very much. I echo obviously a lot of what's been said before, and I would like to say a little bit about what we expect from company disclosures by focusing on what we don't want. And what we don't want is not, what is sometimes called a CSR report, something around corporate social responsibility, where companies find it within the good of their heart to give some money to charity or, to put nice green pictures everywhere. And I'll give you an example from some of our engagements. We were talking with one of the world's largest banks, a very big financier of coal, and they talk in their environmental reports about using dolphin-friendly soap. I'm talking about your investments and your liabilities and your assets. I'm not talking about, the soap that you use in your office or plastic straws. So I think there's still a little bit of confusion as to why sometimes investors expect that point. And that's the point Gabriel just made. And it's one we are also asking companies, what is the strategic link between your company's vision, the role of the company in a low carbon future? And if you think it sounds far away, carbon neutrality by 2050, 2060, in reality, it's only a few business cycles away. You need to start to make a shift of that magnitude to peak emissions and then to bring them down. So companies need to start to thinking about these things now. Now, to give a few more specific examples of some of the things we're asking, obviously transparent emissions data is the cornerstone of this conversation. It starts with emissions, but it doesn't end there. There are obviously other metrics that are important from climate perspective, wastewater, other things, but also taking a broader view along the value chain. So if you think of something like mining, a lot of the emissions in the mining industry do not necessarily originate in mines themselves. They're what happens when, steel makers burn coal, for example, to make steel. Now, to be fair to companies, it's not fully within their control, but it's equally true that when regulation and technology start to corner the market, if you will, that risk can be transmitted upstream. So we want to see companies working with their suppliers, working with their consumers to try and tackle emissions across the entire value chain. And that matters a lot. Another part of the conversation is around policy and lobbying. You will see, I think, growing investor focus on not just what companies say in their reports, but how they're talking to regulators and policymakers, what they're telling through trade associations. Are they supporting climate policy or lobbying against it? That is another thing we're asking companies to be transparent in how they lobby and to make sure their positions are aligned. Governance has been mentioned. It's a very important point. We want to see board oversight, linkages to pay where relevant. And I think it would be fair to say that we try to be constructive with companies. So we give companies homework, if you will, telling them, measured timelines. These are the 5 things we'd like to see by which time. And if they do not sufficiently improve, then we might vote against them across all our assets or divest from certain funds. And as an anecdote, I think this approach has been quite powerful. We have had one of the companies that we divested from a few years ago. Their sustainability team got in touch with us and saying, look, before we were in the front page of, before we were in the FT or Reuters, because you had shamed us publicly, we would never have gotten the ear of our CEO. Now the CEO got in touch, now we have internal buy-in. And indeed, that particular company made sufficient improvements to be reinstated in funds a while back. So that angle that you're telling your expectations, but there's a potential sanction, but also a reward if you step up, I think trying to create those links matter a lot. And recognizing what's been said before, that there's been a transformation from just can you disclose something to looking at the strength of disclosures. Obviously, there's a lot of discussion and focus now around net zero emissions. It's a clear line in the sand now. And that is sort of increasing the expectations of our reporting, or what we like from companies. It's not just can you disclose something, but how aligned are you to that net zero trajectory? And next month, we will be publishing very detailed expectations of companies and climate scores for around 1,000 large companies on our website with, all the data points, who you need to contact if you think the data point is wrong. And that will give you a very clear indicator of our minimum standards that I've mentioned before. We'll obviously follow that up with a lot of in-depth engagement with the key companies we believe are pivotal to this transition. We're also trying to bring transparency to it all, because I think it's been mentioned more than once, if companies don't know what they're being assessed on, if they don't know who to contact, Gabriel mentioned the story that others tell about you. If you don't have that transparency, companies can't improve. So that's also a very important element. Sanctions, clear expectations, and transparency.
Thank you, Yanku, for also sharing with us your views. I think very important keywords I have been receiving from all of you 3 include like governance, right? Not just compliance checking and not social responsibility reporting on your, philanthropy works. And also maybe we need to be strategically, engaging with the companies, but instead of just, asking for something and simply divest them, but we need to, strategically partnering with this kind of invested companies to going forward. I think that's very encouraging. And I also heard from Yanku for some successful cases with the engagement practices. I think that's very nice. Thank you again for our asset managers. Now, maybe I think I will just turn again to Mary again. So we understand that CFA Institute had just done a global survey on what kind of climate or ESG related informations are most interesting to and needed from global institutional investors' perspective. Can you share with us your findings through this survey to give us a holistic picture from overall investor society about what are needed to better enhance the disclosure quality of issuers?
Okay. Thank you for that question. Early in the week, my colleagues in the US published a report called the Climate Change Analysis in the Investment Process. And basically it focuses on the physical and transition risks of climate change. And what we wanted to do is to introduce investors on things like what are the resources out there if they wanted to integrate climate change, or and what are the how carbon markets function. And as part of that report, we actually did a survey early in the year to gauge investors' understanding and approach to ESG and climate change matters. And I think some of the results will be of interest to not just our audience, but to my fellow panelists as well, because it somewhat kind of reinforces what they've been saying. So one of the first questions we asked was how important it is to have a definitive view on climate change in order to manage investments today. Globally, 76% of respondents thought that it was either very important or somewhat important. In APAC, that number is 89%. Okay, now hold that number. A follow-up question we asked was, do you or your organization currently incorporate climate risk into your analysis? Globally, the split was 60-40. 60% said no, 40% said yes. In Asia Pacific, 67%, close to 70% of respondents said no, they are not integrating climate risk into their analysis. So, okay, right, so the number of people in APAC that thought climate change was important was up there. But in terms of actually incorporating climate change into the analysis is only down here, right? So there's a bit of a gap. And then we asked, why don't your organization incorporate climate risk into your analysis? What's blocking you? Okay, the single most selected answer out of a list of 5 or 6 was lack of measurement tools. Okay, 61% in APAC thought that because of lack of measurement tools, that's why they're not incorporating climate risk. And I think that goes to Gabriel's earlier point about data. And then we ask if there's information that investors wanted but don't currently have, what exactly do you want? Okay, and the 2 most selected answers were, surprise, surprise, scenario analysis and climate strategy from companies. Okay, it's like so I think again it reinforces all the work that the stock exchange has been doing, all the on the ground practical experience that Gabriel and Inko have been sharing with us. And one last data point I wanted to share with you. In your opinion, so we are in our survey, we asked our respondents, in your opinion, is engagement or divestment more effective in supporting a sustainable economy? 57% of respondents globally said engagement was the most effective. Okay, those who selected divestment globally was 5%, but 23% of respondents said they were equally effective. And in Asia Pacific, the numbers are pretty much in alignment with the global data set. So I think, again, it reinforces a lot of the work that our membership and other asset managers are doing, and what and goes to reinforce what Gabriel and Ian have been saying. Engagement is key because we need all the issuers to be in this journey. Some of the feedback we've had is that data is getting much better. There's still some way to go in Asia Pacific. There's still some way to go, particularly for emerging markets and for smaller companies. And I think it's a journey that we are all in. We're all invested in, and we need to, as an industry, we need to be able to articulate better what the value proposition is for some of these smaller issuers, so that they're not approaching it purely from a compliance angle. If we think about it, why does anyone do anything, right? It's because it's good for business. B is because the regulators ask for it. And C, because it's the right thing to do. If we can convince people that by having better disclosures, you can hit all 3 boxes, it will be a win-win-win situation, and we'll be on this journey much faster. Thank you.
Thank you, Mary, for sharing with us, the survey results from CFA Institute. And I think more or less it's quite aligned with, our awareness here. It's important. Yes, integration is important, but we are still in the journeys. And maybe, more capacity buildings like today, what we have been doing is quite important in the near futures as well. So Actually, now we are receiving Q&A, the questions from the floors. If you have further questions, please remember to type in either for the Q&A functions or the chat functions. We will be looking at that and have this Q&A afterwards. So the final part will be also we're coming back to Kelly again. So can you actually also share with us maybe in the futures from Hong Kong EX or other regulators in Hong Kong, there's any further plan to increase the transparency level? As you know, Ianco mentioned a lot, transparency, right? Is there any further plan to increase the transparency level and accuracy of ESG and climate-related information disclosures for issuers, please?
Thank you, Joy. I think as Catherine and some of the panelists also mentioned, that this journey, the whole process is a journey. So of course we will keep reviewing our issuers' performance and see what further assistance or what further enhancements we can make to our framework. And in respect of the usefulness of the information, in fact, some of the our new ESG requirements also try to tackle this point. For example, we have we now shorten the ESG reports publication time frame so that we try to improve the timeliness of information so that it will make the data a bit more useful to the stakeholders. And in respect of, we also ask the issuers to set targets in respect of certain environmental KPIs. We try to urge them, ask the issuers, help them or facilitate them in setting targets in order to keep monitoring and scrutinizing the existing mechanisms in respect of data, in respect of emissions, so that they can evaluate the effectiveness of the whole process. And issuers are also encouraged to seek independent assurance to strengthen the credibility of the information disclosed. And I think a large part of, in terms of improving the quality, I think as you mentioned, capacity building is very important. And we know that our issuers need a lot of guidance and more help in this aspect in order to understand their role and understand of how to do it. And we try to provide the market a range of resources. We have different formats. For example, we have directors e-training or webcasts trying to tackle this aspect more higher level education to the directors. And in our latest series of e-trainings, we focus on the new ESG requirements, including the climate related disclosures. And I urge the companies or our issuers can go and have it and check it out. And we also have, in terms of governance, I can't agree more with what Gabriel has said, is the importance. And what really matters is that the whole ESG reporting is not just a check the list or just a compliance thing. It's more like we are more interested in how you arrive at your conclusion and what's the process or what steps you have taken. And that's why we made a tailored guide for directors to talk about their leadership role in the whole ESG process. And of course, we realize that not all of our issuers have dedicated ESG external consultants for them to help them to provide the reports, and that's why we also have a step-by-step guide to take issuers through in respect of the ESG reporting process. And we have included the latest thinking, such as the TCFD's recommendations on governance and climate-related disclosures in that step-by-step guide. And I think because this climate change or sustainability or ESG is cross-sectoral matter. In fact, the local regulators, financial regulators in Hong Kong have gathered together and formed the Green and Sustainable Finance Cross-Agency Steering Group. This has been established in May this year. Through the steering group is trying to help to have more collaborated approach in regarding the regulatory policy going forward, as well as the market development to foster the Hong Kong's position as a green and sustainable finance center. And I think what the other panelists has mentioned, I think this to build the whole ESG ecosystem does not rest only on the regulators or the companies. We all have to work together, including asset managers, different associations like HKGFA, and we need to all work together in order to build this ecosystem together. And I pretty agree that the engagement with, especially from the investor side and asset manager side with the company is very crucial, because one of the feedback we always got from the company is that I don't know what they care or I don't know what they want. And I think the useful engagement will be a key to further improve the quality of the disclosures.
Thank you, Kelly, for the kind sharing again with us on the future, what to be anticipated, right? So conscious of the time, we are already 10 minutes, late for the scheduled time, which is quite, interesting and promising discussions happening here. So we will just only take one question, okay? And the question I think is most of the issuers will be quite concerned about, and the question is going to Kelly actually. So the question is, are there any consequences for a listed company if they do not comply or explain in a satisfactory way if following Appendix 14? Can you help to answer that? Thank you.
Yeah, sure. I think the key thing I want to talk about is how you see the compliance or explain. I mean, when you say, oh, whether your explanation is satisfactory enough, is go back to our what we just mentioned and what Gabriel just mentioned. The reporting is not a checklist. We think about it. If you not write a good enough explanation, what's the consequences? Is that your investors, the report readers, will find it not convincing, or you haven't really addressed the concern. It's not the exchange judging or whether you have a satisfactory explanation. So I think in terms of consequences, of course, if you do not comply with the requirements in the ESG guide, you need to explain it. And if you fail to disclose the explanation, is a listing rule breach. But if you are talking about whether the explanation is good enough, it's more about what you want the readers to know about your explanation, if you see what I mean. And of course, we when we look at issuers' disclosures, we will publish our review analysis, and we will try to identify some weakest link from the issuer's disclosures, and we will try to provide some more guidance in terms of what you can say when you explain. Is more a guidance perspective in terms of how you can improve your disclosures in that regard.
Okay, thank you, Kelly, for the kind explanations here about what's comply or explain. Okay, conscious of the time, thank you again for all the panelists here today. For the questions haven't been answered, you may find the contact details of Hong Kong GFA at the end of this workshop, and we can keep contact and to have further discussions in this regard. So thank you again for all the dear band panelists to join us today. We are now ending this panel discussion. Thank you again.
Thank you, Joy.
Thank you all.
Yes, thank you.
Thanks.
Okay, dear all panel, dear all participants, it is very insightful for all of us to understand what and why the climate-related issues are important and useful. Now, it is exactly the right time to provide capacity building to the audiences on how to identify, analyze, and disclose climate-related risks and opportunities according to the latest ESG guide published by Hong Kong EX. So now we are entering into the next training sessions provided by our training partners. Okay, so the first one will be training workshop 1, themed in how to prepare climate-related disclosures and environmental target setting. And the trainers include Flora Yu, Manager, Sustainability Department, CSAP Environmental Consulting Group Limited, and Junfeng Zhao, Assistant Vice President, Green Finance Department, CSAP Environmental Consulting Group Limited. So now, both Flora and Junfeng, I will hand you to both of you, and you can start to do the screen sharing now. Thank you.
Okay. Hi, Joy. Can you see my share screen now?
Yes, maybe you can try to zoom it. Yeah, to make the full screen. Thank you.
It looks better now?
Yeah, it's okay.
Okay, thank you. Hi everyone. I'm very glad to be here today and share you some feasible approaches to identify and manage climate change related risks. So first of all, let's have a overview of the new climate change disclosures requirement. I believe that most of you have heard that already. The A4 aspect in ESG guides, which came into effective on July 1st this year, includes a general disclosure and a KPI. In general disclosure, it requires issuers to disclose their policies, which are used to identify and mitigate their significant climate-related issues. So there are two keywords here, identify and mitigate. The disclosure policies should be used for these two purposes. As for the unique KPI in A4 aspect, it requires to disclose how the significant climate issues impact the issuers and the actions taken to manage them. So in overall, there are three main elements that you need to disclose: the policy, impacts, and the corresponding actions. And so in terms of identifying climate issues, we will start with how to integrate climate management in the organization and then discuss how to identify climate issues. So in these slides, we make reference to the enterprise risk management framework and provide you a typical conceptual chart here as an example. Normally, as you can see in the right-hand side of the slides, the board at the top level is responsible for overseeing management's approach to climate risks, as well as ensuring there is a program in place to identify, assess, manage, and monitor climate risks effectively. So then the risk committee directly on the board should establish the direct oversight of enterprise risk management, including the climate risks. Then the executive team is also a critical connection to strategic planning and operational personnel. This connection supports timely assessment of risks so that the organization is better prepared to identify risks and related opportunities. Under the executive team, there are always various functional managements. For example, the Sustainability Department provide support in coordinating climate-related activities. And the enterprise risk management function should be responsible for coordinating and consolidating enterprise risk management activities, as well as leading the process for managing enterprise-wide risk in an integrated and systematic manner. So for other cross-functional managements, there are also a strong support, which can provide perspective on particular aspects on climate issues and other risks. So here is a typical governance structure to embed climate awareness in an entity's culture. So here we got an example from BP, the former British Petroleum, which is a British multinational and oil and gas company. The screen capture on the right-hand side is their climate governance structure. The assessment and the management of climate-related matters is embedded across BP at various levels, and the dedicated authority flows down from the board. Although the board is not shown on this structure, BP disclosed in their annual report of 2019 that the board and its associated committees have oversight of the climate-related matters. The executive team is then supported by BP's senior level leadership and their respective teams with functional expertise focused on climate-related matters. This includes their carbon management, safety and operational risks, group policy, and their economic teams. Then the alignment between group business and functional leaders is fostered through across functional bodies, including the carbon steering group, upstream and downstream carbon steering committees. As you can see that the governance, climate governance structure of BP is not exactly the same as the general one in previous slides. We do suggest that entities should establish their own structures based on their business context. So this is just an example here. When with the climate governance structure in place, then how to start identifying your climate issues? The answer is starting from where you are the most familiar with. From a general perspective, the first step is to review your business and find out the key areas that would impact your capital, assets, expenditure, revenues, and etc. For example, if you are in a traditional industry with high carbon emission, you may encounter the risk investors' request on decarbonization. And if you have assets near seaside, you may have to consider the impact of sea level rise on your assets. So then the next step we recommended is to list out and try to describe the issues, their root causes, the corresponding impacts, no matter past impacts or the future anticipated impacts on your operation. And the third step is to map the issues to corresponding departments in terms of probability, exposure, and consequences. Then the following is to validate the identified issues with corresponding departments, estimate the impact in terms of financial indicators on the different scenarios, especially the 2-degree scenario, which is aligned with the Paris Agreement. So for the identified climate issues, no matter risk or opportunity, try to describe the existing or potential responses with corresponding departments and then estimate the cost to control them. Combining all necessary analysis, it's time to define the substantial financial impacts of identified issues and rank them by matrix based on financial impact and the probability. Before disclosing such climate-related issues, remember to categorize them into different categories. This is an essential step to facilitate the understanding of your stakeholders. Then through this section, we will talk about the general process to manage climate issues and show you 2 typical examples of managing physical and transition risks. For the management of those prioritized climate issues, there are 3 key aspects that we recommend entities to take into consideration: strategy, finance, and operation. From the strategy level, it is recommended to develop near, mid, and long-term goals and plans based on your business strategy, of course. And then the financial plans should be carefully developed in order to get approval from your boss, right? And on the execution level, operation plans should be created with sufficient human resources to effectively implement the risk management plan. Here we've got a case study from Coca-Cola. The identified physical risks that Coca-Cola exposed will limit availability of their ingredients and raw materials and disrupt their production and limit distribution. All of these will definitely cause business impacts on their production process. For example, it may increase cost of packaging materials, manufacturing, distribution, and cold drink equipment. And there will be also reputational risk among their customers if they don't properly address the climate risks. So in order to respond to those identified issues, Coca-Cola developed different initiatives to build climate resilience with progressive targets. For example, they set out sustainable agriculture guiding principles to promote sustainable agricultural practice and build their suppliers' capabilities to meet those standards for environmental protection and responsible farm management. Coca-Cola have a core team internally to drive their corporate strategy on issues related to climate change, with inputs from a broad set of functions such as enterprise risk management, procurement, operations, technical and public affairs, and the sustainability department. Coca-Cola also asks their suppliers to demonstrate they are meeting the sustainable agriculture guiding principles criteria by using the global sustainable agriculture standards and assurance schemes. So there is a very impressive example shown by Coca-Cola. Another case here is also from BP. Let's see how did they deal with the identified transition risks. BP talked about that climate change will increase their cost, reduce demand for their traditional energy products, and thus reducing revenue and limiting certain growth opportunities, which make it urgent for them to transit to a lower carbon economy. The solution is that BP built up a climate governance with clear responsibilities to manage their investment. There is a renewal committee directly under BP's board, as you can see in the slide, and chaired by a chief transition officer, which is responsible for reviewing strategical, commercial, and investment decisions outside core activities and related to new business lines. There are two sub-ordinate committees here, the New Energy Frontiers Steering Committee and the Ventures Investment Committee, to oversee the growth opportunities in low-carbon business model and venturing business. The examples here we provided from Coca-Cola and BP exactly a different approaches to address physical and transition risks arise from climate change. The common things between them and we want to address here is you need to set out a feasible plan and provide sufficient capital and human resources support. For the rest part regarding target setting, I will pass to my partner Junfeng for further sharing. So Junfeng, now the mic is yours.
Thank you, Flora. Can you hear me?
Yes, yes.
Great. Hello, everyone. Thanks for joining. And I'm Junfeng from CCPC, and I'm glad to share my thoughts on target setting with you in the following several minutes. And I'm going to share my thought on GHG-related target setting and other environmental target setting. Next page, please. Next page, please. Yeah, thank you. So let's have a big picture on target setting. Previous page, please. The target setting page, yeah, sorry for that. So let's have a big picture on target setting. Target setting is a commitment and pathway towards sustainable economy. Typically, there are two basic approaches to set a target. The first one is a bottom-up approach, as shown in the left-hand side, and it focuses on feasibility. So companies could account their emissions and select base year and target year, and also deliver a scenario analysis with growth forecast and emission reduction forecast. And at last, deliver a cost and benefit analysis to make sure that the target can be set. So in the, as illustrated in the picture, we have set 4 scenarios for a company A, and the 4 scenarios have different assumptions in policy that influence availability of renewable energy. So we can see the different scenarios result in different reductions in the future. And this helps companies understand what they can expect with current policy and what they may need in terms of policy supporting in order to achieve their ambitious targets. And in the right-hand side, it is a top-down carbon budget allocation approach, which start with a carbon budget for different targets, such as a 1.5 degree target or below 2 degree or 2 degree target. Within the ambitious level of truth, the emission scenario is developed. Firstly, the emissions are allocated along the time, which is a timeline allocation, and then it is allocated to sectors and companies. And I will touch this part later. Okay, next page, please. Okay, so let's have a look at the bottom-up approaches. So there are key elements in the bottom-up approaches, which is accounting, identification, and forecast. I think accounting and forecast are quite straightforward, and I would like to explain identification more, which includes two key parts. The first one is to identify the material emission sources and identify the potential reduction means. That will be very helpful in order to understand how much reduction you may achieve in the future. And the other part, which is also very important, is like key indicators that links the business activity and the emissions. And I will talk about more in the next page, please. Okay, so why business activity intensity matters? Because it bridges the past, present, and the future. In the left box, we saw that material emissions identification, including Scope 3 accounting and also key parts of reduction potentials. And in the middle box, there comes the importance of the business activity. When we try to forecast the future emissions, we will need to understand how much the business may grow in the future. And you need the link between the growth and the emission in order to figure out the emissions from business growth. And this is the business activity intensity. And that helps you to split the change from output change and find out what is the actual reduction you may achieve in future. And in the right side of right box, there are other scenarios we may share with you about our understanding. So you can deliver two basic scenarios in the for the target year with different output forecasts, and then you can find out what different measures may lead to and what other measures you may need in order to achieve your target. And this kind of practice is very important for the feasibility study because setting a target is easy, but it is important to make sure the target can be achieved. Next page, please. Okay, so from this page, I'm going to talk about the top-down approach. Science-based target is a typical top-down approach, which aligns with the Paris Agreement. In short, science-based target is projecting Paris goal onto a company. And I think we have CDP's colleague and expertise here who will who may introduce more about the science-based target in more detail. As you can see, CDP is a key partner of the initiative. What I'm trying to highlight here is that in Greater China, there are already some leading companies setting and committing to science-based targets. So this is not too far away from our content. And I recommend companies to think about setting a science-based target. Next page, please. Next page, please. Thank you. Okay, so this is a brief introduction of the methodology of science-based targets. The key element here is the carbon budget, emission scenario, and allocation approach. As discussed before, this is this methodology is trying to allocate Paris Agreement goal onto corporate level. So we have set some carbon budget to achieve different ambitious level of the target, such as 1.5 below 2 or 2 degree. And with that carbon budget, you need to allocate the budget along the time. So like how much you can emit in 2020 and how much you can in 2030. And after that, this emission budget should be allocated to companies. And there are two typical ways to allocate, which the first one is assuming all the companies reduce their emissions in the same pace and ensure the goal can be achieved. And the other one is a sectorial approach, which sets some more tough targets for those high emitters. And combining this, both of these two approach, we may get the targets achieved, since most of the companies reduce their emission at the same pace, and some of them reduce even faster. So I hope CDP colleague will discuss more about that later. And next page, please. Okay, so again, carbon neutral. To be carbon neutral or not to be, that is the question. And before we answer the question, we need to be more specific on what is carbon neutral. Typically, you should understand the boundary clarification, and ideally, the carbon neutral shall include all GHG greenhouse gases, and it shall cover all your value chain. And in the middle of the page, I have also shared some key measures to achieve the carbon neutral. The first one is offset, the second is removal, and the third is reduction, actual reduction. And I think at the end of the day, we need to achieve the carbon neutral with a mix of three measures, because each of them have their pros and cons, such as, let's say the offside, it can be it can be good for some companies, some single companies, but for the whole society, we don't have such much of such mass resources to offsite. And for the removal, the price is quite high at the moment, and we need technology development. And for reduction, you know, there's some kind of emissions or some sources may not be reduced. So ideally, this shall be achieved with a mix of three measures. And this is just a very light touch of this carbon neutral topic. We can discuss that further if you have interest afterwards. Okay, next page, please. Now, let me discuss other environmental target setting. As Catherine has mentioned before, this broader environmental topics are interlinked with carbon and GHG emission, such as waste. You know, you can get a lot of emission from waste treatment, and also the energy use efficiency is related to reduction, and water also very important topic for climate resilience. And what I'm going to highlight here is that we highly recommend companies to set an actual numerical figure target, although a directional target is accepted now. I will talk about that, why you should set an actual numerical figure in the next page, please. Okay, so this is a board involvement and statement in the target setting process. Boards are asked to share, to review the performance against the target, and also disclose the evaluation progress, and also provide a lot outlook on why this is main challenge, why this is material for your business. In the right side, we listed some measures that the company shall consider when review the performance and disclose to the stakeholders. With these measures, you may share an even bigger picture for your stakeholders to let them understand how your peers perform and how is performance audited or verified. Next page, please. Next page, yes. Okay, so the case study of CLP. And CLP actually is a very good example. It includes the most important elements for target setting. So first, they have a very long-term target. It's aimed at 2050, and it has a very important intensity, which is linked with their business activity, and this makes it more reasonable and more easy to understand how this may influence others. And also they set targets, step by step, and review it and update it accordingly. This is also a very good practice. So the targets are not set once and let it go. It's updated and review it. So this is, we may share more about this later, but according to time, I will go a little bit faster. Next page, please. And this is another case of Hong Kong Airport Authority. The company also set emissions, intensity emissions, which is linked to their business activity. And in the right side, I'm recommending another kind of environmental target, which is a waste target. And this is very important for airport authority and its material. And this example shows that what other environmental targets shall be set for companies. Okay, I'm cautious about time. Let's go for the next page, please.
Hi, Junfeng, are you still here?
Can you hear me?
Yes, we can hear you now.
Sorry, I dropped. So let's go. Let's have a recall of the procedure. Such a long road, isn't it? Material analysis is always the start, and you shall verify your emissions inventory and plan for that. And with a feasible plan to achieve the target, you may get approval by your board. And once again, it is very important to highlight that feasibility study is very important for target setting, because with that you can get without that you can't get approved by your board. And then the most important thing after setting targets is to review the target, review the achievement, and update the target accordingly. And I'm sorry if I ran in fast, and my session is finished here. Welcome for a question. Thank you very much.
Hi, both Junfeng and Flora. You can check the questions in the Zoom webinar chat. And I also saw 2 questions for you. One is relevant to the presentation slides, and another is relevant to the emission induced by human resource. Can you help to answer both of these questions? Thank you.
Okay. I'm sorry, I didn't see that question. Can you please read that for me, if possible?
Yeah, I'm looking for the questions. The first question is about the PDF we shared today from Jimmy Liu. Will a PDF be available for CSAT Press? Yes, we will spread out the PPT we shared today in our social media. Please follow up us. And I'm looking for the second question. Here is. Okay, another question is a little bit long. How do you attribute the emissions induced by human resource? Let's compare the 2 cases. The first one, a company which automates all the production process with machines and softwares. And second one is another company which produce their goods with all human handmade. As a result of the first company spends more on electricity but less on human resources when compared to the second one. How do we document the hidden emission induced by human instead of machines? Okay, I think this question is more relevant to Junfeng's parts about the emission data and target setting.
Yeah. Thank you, Flora, and thank you for asking the question. It's a very good question, and it goes very deep. I think this is why I'm talking about the business activity in context of the companies, and actually the emissions from machines, it differs from a scope. Some machines will generate scope 1 emissions if they consume fuels, and some of them may generate scope 2 emissions. And I think every company has their scale and has their revenue scale and the business scale, and actually the emissions are allocated to different companies, and which is linked with their baseline business activities. So companies are all reduce their emissions within their certain circumstances, and I think this is not a very important thing to compare how much you reduce to a company who has a different business type with compared to you. So I think companies shall focus on their own emissions and own development. And I think actually for those companies with more machines, there shall be the emission reduction may generate more benefits than those companies with more people working on production, because energy saving can generate more cost saving as well. I hope I answered your question.
Okay, thank you, Junfeng, and thank you, Flora. Conscious of the time, we may need to end the training session 1 here. For further questions raised by the other audiences, you can definitely reach the trainers according to the information they showed on the screen now. So thank you again, Junfeng and Flora, for your sharings. Can you please end your screen sharing now? Thank you.
Okay, thank you, Joy.
Okay,
thank you.
So Yeah, thank you. Before we get into the training session 2, and we understand we have kept CDP for quite a long time to wait for the panel discussion and also the training session 1. Before we get into the CDP trainings, I want to get a very quick, polling questions to all of you. It's very, very simple, and you can see it on your screen now, because it could, well helping us to better design our capacity building related programs in the future. So please help us to do this polling questions. It is totally anonymous, and I'm going to end it in 5 seconds, okay? Okay, thank you for letting us know your views on this. I'm now closing the polling and let you to see the results of it. And we can see for other topics, most of you may more interest in the capital market related one, as well as ESG governance and assurance. Okay, thank you for this. It will help Hong Kong GFA to better design our capacity building program in the future. So I will finish the poll questions now. And the last sessions is about the training workshop 2. So please allow me to share my screen to introduce our great trainers from CDP. So the training workshop 2 is related to understanding TCFD and mapping to Hong Kong EX ESG guide and investor expectations. We have already heard from our panelists emphasizing on the importance and general recognitions of the TCFD as a framework to be used in their climate-related disclosures. So we are very glad to have both Pratima and Joseph to joining us today to give their sharings on this topic. So let me give a brief introduction. Joseph is from CDP Hong Kong, and he is from the corporate engagement. And we also have Pratima. She is the regional director of CDP Hong Kong. So now I will end my sharing, screen sharing again, and hand to both Pratima and Joseph. Thank you.
Thank you, Joy. It's a pleasure to be here today. I'm just going to share my screen. So just let me know if you can. Are you able to see it now?
Yeah, very clearly.
Perfect. Okay. I'm going to, just address a couple of things that Junfang said earlier with respect to science-based targets and SBTs. I think very relevant and should be spoken about. Unfortunately, we won't have the time to do that today. But I just want to highlight that we are coming up with a 4-part Asia series to introduce science-based targets, and that will take place on the 20th of October onwards. So, and we're doing this in partnership with the World Resources Institute, the local chapters of UNGC and WWF. So that should be coming up shortly. I'm going to just skip a few of the slides. Just wanted to highlight over here for those that don't know us, what we really intend to do is CDP basically standardizes the reporting framework. We're a reporting platform, and what we've done is we've standardized the questions which are required under the TCFD guidance. And what we generally do is all of the companies that report to us, we then provide that information back to the investors that have requested for such a data, or to the companies that have requested for this data from their supply chain. And the reason why we do standardize these questions is because then it helps us evaluate. So basically we provide a scoring for every report that the company generates on TCFD through our platform. Now, being a not-for-profit, our scoring methodology is public. So it's available on our website if you would like to take a look. And the general idea behind evaluating all of these reports is then it is better used in financial decision-making, but also it helps companies benchmark themselves against their peers. This is a very quick snapshot of the number of companies and the geographic spread of the companies that report to us in Asia Pacific. And there's about 2,500 plus that reported in 2019. Our largest reporting region is the Greater China region. In 2019, we had over 1,100 companies that reported over here. And before jumping into the Tcfd framework, and just picking on some of the panel discussion questions on the amount of frameworks that are out there, standardization, etc., I just thought I'd take a couple of minutes to really differentiate sustainable development, ESG, and where the Tcfd sort of fits into all of this. So if we are to really sort of condense the history of sustainable development, there's 3 key mainstream events that really stand out. One is, of course, the definition of sustainable development. You see that on the left-hand side of this slide. The second key event that really stands out is that on the basis of this definition, we developed the 17 UN Sustainable Development Goals, or the SDGs. And basically what the SDGs really recognize is the need for continued social development, present and future, but in a world of finite resources. And what the sustainability reporting frameworks today have done is they've adapted these 17 policy goals into environmental, social, and governance, or ESG guidelines for corporates. Now, one specific goal has warranted and received much more attention from policymakers over the years, and this has been SDG 13, which is on climate action. And there has always been a need felt to develop specific standards to better understand vulnerabilities with respect to climate change. And so this brings us to the third mainstream event, which is the Paris Agreement. I'm sure you're very well aware of it, so I'm going to skip the description on that. But what I want to highlight is that in the Paris Agreement, for the first time, it was really recognized that finance flows are very important to transition to a low carbon economy, and those finance flows need to be consistent. This is essentially what spurred the Financial Stability Board to set up the Task Force for Climate-Related Disclosures, or TCFD, to review how climate issues are being priced and accounted for. So while ESG covers broader concepts on environment and social and the governance surrounding it, TCFD is primarily focused on financial issues in relation to climate risks and climate opportunities. One thing to remember is, of course, that TCFD is aware that these guidelines need to be built into existing frameworks. My colleague Joe will show in the later slides how stock exchanges and other existing reporting platforms are already aligning with the TCFD. Before I jump into the components of the framework, I just want to very quickly highlight that the TCFD framework, while it is applicable to all sectors, it is particularly relevant to the 5 sectors and the subsectors that you see on this slide. The reason being that companies in these sectors directly influence climate change and are also, as a consequence, likely to have the most impact if we are to transition to a low carbon economy. So if you operate in these sectors or manage or own assets in these sectors, then it is recommended that you disclose under the TCFD framework. Now, coming on to the framework itself, as mentioned earlier by other panelists as well, TCFD really aims for companies to understand what the climate risks and benefits are to a business's operations and what the financial impacts, which could be negative or positive, may be to a company. So for this reason, the TCFD framework should really be considered within a company's overall enterprise risk management framework. Now, climate risks broadly fall into 2 categories that Junfang mentioned. One is the transition risks, and the second is the physical risks. Transition risks are essentially risks that a business is likely to face in our global transition to low carbon. And these typically involve higher compliance costs, higher insurance premiums, threats from low carbon technologies, and what their impacts may be on your current R&D or your current product and service portfolios, or early retirement of assets due to policy changes. Physical risks can be acute risks, that is extreme weather events that tend to cause large-scale disruptions, or they can be chronic, which is essentially long-term shifting climate patterns that directly affect the physical locations of your business or indirectly impact the physical locations of your supply chain. And one of the things to also understand when developing a strategy is to consider the time scale and what are the impacts and how they're going to impact you on a short, medium, and long-term basis. Now, some companies have assessed climate risks and they've said, while in the short term, this impact is not material, on the long term, they feel that certain climate risks could potentially have higher business and financial impact. So time horizon really becomes a key component of assessing impact and materiality of a climate risk and opportunity. Now, there's of course different methods to consider climate horizons. Some considered on the basis of some international trends. They say 0 to 3 is short term, 3 to 5 is medium, 5 to 15 is long term. Some others actually use their scenario timeframes within their overall business strategy, long, medium, and short, long-term timeframes. Now, one of the common questions that we also get asked is how are financial institutions using all of this climate information that companies are producing already? And we are now seeing that this information is really getting filtered into financial decisions. The panelists mentioned, it comes into monitoring, it comes in engagement, it comes in investment due diligence. And where it's now proceeding towards is new financial products and services. So just to give you a couple of examples, CalPERS uses CDP's greenhouse emissions gas data set for engaging with their high emitters within their portfolio. We also have IFM, which is an asset manager in Australia that considers climate due diligence in their investment decisions. And they also do carbon footprint reviews of investments in certain asset classes. And also all of this data is getting integrated. So, in the case of CDP, for example, our data does feed into other ESG data providers and in the calculations of their ESG ratings. And of course, financial regulators are also becoming increasingly very active in understanding the implications of climate risks and the transition to low carbon. A couple of the panelists did bring up China's ambitions, which was announced a couple of days ago. In 2017, we also had the Network for Greening the Financial System, or NGFS, which has about 69 central banks that have come together to work under this network, and China and Singapore are on the steering committee. The NGFS is already seeing a lot of action in Asia Pacific. Last year, we saw several policy statements made by central banks of Hong Kong, of Singapore, from Malaysia on their stance on green and climate finance. And in Australia, the Reserve Bank has publicly endorsed the TCFD, while New Zealand very recently became the first country in the world to mandate TCFD reporting across its financial system. I will now hand this presentation over to my colleague, Joe Gualtieri, who will walk us through how stock exchanges are incorporating TCFD within their reporting guidelines. Do feel free to send in your questions and we will answer them directly in the interest of time. Over to you, Joe.
Good afternoon, everyone. I just want to confirm that you can all see my screen.
Yes, we can.
Like you can. Great. Okay. So yeah, thank you very much, Pratima, for handing it over. And thanks again to the NGFS for inviting us to contribute today's program. So yeah, my name is Joseph Gualtieri, and I'm on CDP's corporate engagement team. And just over the next few minutes, we'll briefly demonstrate how some of the HKEX ESG requirements align with the TCFD guidelines. And I'll also highlight areas where companies can go beyond the current listing requirements and show progress on environmental stewardship. So here we have mapped the HKEX ESG requirements against the recommendations of the TCFD. And on the top row, we have the 4 pillars of the TCFD. So that is governance, strategy, risks and opportunities, and metrics and targets. And in the columns below, we have the disclosure recommendations associated with each pillar. And so in the green cells, beside the TCFD recommended disclosures, we've indicated where the HKEX's 7 mandatory disclosure requirements align with the corresponding TCFD recommendations. And the yellow cells indicate where HKEX's comply or explain provisions are at least partially aligned with the TCFD recommendations. And then below the colored cells, in gray cells, I've indicated the questions in CDP's climate reporting platform that align with each of the TCFD recommendations. So what we find is that as the HKEX ESG requirements are aligned in part with each of the pillars of the TCFD recommendations, the HKEX requirements can function as a very valuable starting point for companies new to measuring and managing their climate impact. And so companies could begin or continue their journey by addressing first the green cell mandatory climate disclosures, and then move throughout each pillar then to the yellow comply or explain provisions. And then finally, moving on to fulfill the full set of TCFD recommendations. So in this way, we would hope that companies can use the HKEX requirements and the TCFD guidelines really as a roadmap towards providing the environmental data most relevant to the capital markets, as we've heard a few times throughout the day. And again, as came up during the panel discussion, investors often use TCFD reports both as a tool to assess a company's progress towards sustainability, but also in a wider sense to engage with their investee companies. So it serves those two purposes. So if we direct our attention to the first column on governance, the governance pillar on the left, we see that the HKEX requirement to disclose board level oversight of climate related issues meets the first TCFD guideline. And what a fully aligned TCFD disclosure would entail would include providing that information about board level oversight, but importantly, would also include information about the management level structures that are in place to monitor climate related issues and ultimately to execute the board's vision and strategy for progress on these climate related issues. And here we just have a quick illustration of why it's important to gather data on both the management level engagement and the board level oversight of these climate related opportunities and responsibilities. So using data from CDP responses submitted by APAC companies in 2019, it's over 2,500 companies, as Pratima pointed out, we find that nearly 80% of companies report board level oversight of climate related issues, which is at first glance a very encouraging figure. However, if we dive into the data a little bit, we find that indications about incentives given to management of climate-related issues, we see that less than 2/3 of companies offer any incentives at all, and just 13% of companies offer monetary incentives for the attainment of climate-related targets. And so one thing that this gap between the board's vision for climate stewardship on the one hand and the incentives offered to management to realize the board's vision on the other hand tells us is that there is this gap here, and that really only becomes apparent in the context of full TCFD disclosure, getting information both about the board responsibilities and the management structures in place. So in this way, we've found that stakeholders really do desire that detail, again, about both levels of management and oversight as a necessary way of forming a complete picture of the company's climate governance capacity. So going back to the mapping document with respect to the strategy pillar, companies that already meet the HKEX disclosure provisions can, again, go beyond the listing requirements by identifying risks and opportunities across the short, medium, and long-term timeframes. And as Pratima mentioned, this is especially important given that climate change is a dynamic process and that climate conditions will vary over an extended period of time. And relatedly, as we've heard a few times today, TCFD recommendations also encourage companies to use scenario analysis to assess a company's resilience across a range of potential climate futures. So scenario analysis, as was mentioned before, is a forward-looking tool which allows investors to anticipate company performance in the context of a changing climate. And we've been hearing a lot about this lately. So for example, Ashley Alder of the Hong Kong Securities and Futures Commission recently called scenario analysis, quote, the bedrock of TCFD disclosure. And the Hong Kong Monetary Authority, as you see here, in their recent white paper on green and sustainable banking, identified scenario analysis as one of a component of one of their key principles. And they described scenario analysis is, quote, crucial for management of climate-related risks. So we certainly are seeing quite a bit of interest in that coming up. And so given the importance of scenario analysis, CDP's questionnaire does provide opportunities with companies to provide relevant information about the use of scenario analysis. So if you look in the lower half of the slide here, you'll see our question 3.1b, which asks companies to provide data. So we ask for data both on the technical aspects of the scenario analysis, that is to say the relevant inputs and assumptions, the models applied, and so on. And we also ask for information on how the company incorporates the data into their objectives and strategy. And as you can imagine, a complete response to this and related questions on business strategy really does provide decision relevant insight into a company's capacity for climate resistance, and just gives an indication of the degree to which the company operates with a view towards long-term sustainability. So looking now at the risk management column, after meeting the HKEX requirement to disclose how the company identifies, assesses, and manages climate-related risks, companies can show best practice by then disclosing how climate-related risks are integrated into their overall risk management system. And doing so provides a signal to the capital markets that the company views climate change as critical to the success of the company, and that these risks, these climate-related risks, are viewed holistically and seen in line with other more readily identifiable risks to company performance. So going back to our 2019 analysis, we found that just about 2/3 of APAC companies had identified climate-related risks, and these included both transition risks. In one case, we had a Korean power generator reporting higher R&D costs in order to switch to the provision of renewable energy, and physical risks. And so one that stood out to me was a Japanese construction firm that had to install high-efficiency rain gutters in the face of an anticipated increase in rainfall. So regardless of the risks that are identified, after identifying these climate-related risks, our questionnaire then asks companies to describe where and how they expect the identified risks to impact their business. And here you can see the various at-risk categories that companies identify, like their products and services or their supply chains. And for each category, the 2 red bars to the left indicate that companies are already reporting that climate-related risks have impacted their business. And as you can see, companies in APAC report that all areas have, in one way or the other, been impacted by the identified risks and opportunities. And we expect that data of this type would also be captured in the HKEX disclosure requirements. So similarly, this chart shows what the same companies then reported when asked if the identified risks and opportunities had impacted their financial planning process. And what stands out here is that whereas in the previous chart, we saw companies reporting risks and opportunities across all areas of their business, here we find that companies have seen their financial planning process impacted in only 4 of the 7 categories listed. And one of the things that this suggests is that the financial planning processes have yet to address the identified risks and opportunities. And of course, each of these aspects of financial planning will have a different level of importance to individual companies, and the gaps between the risk impacts identified and the financial planning will tell a unique story for each company. But however, both these unique stories and the broader trends that they represent really become visible to stakeholders only when companies provide these fulsome disclosures through the Tcfd framework. And as for the metrics and targets pillar, once companies have gotten a handle on their own Scope 1 and Scope 2 emissions, as requested in HKEX items A1.1 and 1.2, the natural next step would be to address Scope 3 emissions, which are the indirect emissions embedded throughout the company's value chain. And for many companies, Scope 3 emissions will be the most significant source of emissions. And so a company's awareness of its Scope 3 emissions really is critical in identifying relevant risks and minimizing the impact throughout the company's value chain. So in addition to being a TCFD requirement, reporting Scope 3 emissions is also a component of the GHG protocol, which is an acknowledged leading global standard for corporate carbon accounting. And as you can see from the chart on the right, according to data gathered in a recent CDP study of supply chains, companies' supply chain emissions are on average about 5.5 times greater than its direct emissions. And so again, an understanding and a capacity to manage Scope 3 emissions really does play a key role in limiting emissions overall. And CDP's questionnaire captures Scope 3 emissions data among each of the categories defined by the GHG protocol. So for example, the questionnaire asks about emissions embedded in purchased goods and services, transportation upstream and downstream, the use of capital goods, and so on. And we also ask companies to report the evaluation status of emissions associated with each of these categories. So where Scope 3 emissions sources, a given category, is considered relevant, the companies are asked to provide the data associated with that emission type, and also the relevant calculation methodology used to gather that data. And where emissions from a given category are not considered relevant, companies are given an opportunity to explain why. And so in either case, whichever the company reports for a given Scope 3 category, we find that this level of granularity in Scope 3 emissions data really does provide stakeholders and the company itself with a much clearer understanding of what contributes to the company's overall emissions profile. And finally, I'd just like to say that one of our main goals at CDP is to standardize corporate reporting around the recommendations of the TCFD. And as you can see indicated in this chart, which is put out by the Corporate Reporting Dialogue, we've seen the leading frameworks begin to converge around the TCFD. And so the disclosure frameworks listed on the top right of this chart, that is to say CDP, GRI, SASB, and IR, are all members of the Corporate Reporting Dialogue. And they all translate TCFD recommendations into disclosure requirements, which then generate metrics that allow investors and other stakeholders to measure corporate performance on climate issues. And in coalescing around the TCFD recommendations, our hope is to use the guidelines to both lower the overall reporting burden for companies, so by minimizing the number of frameworks and standards, but also allowing companies to produce more comprehensive decision useful data that will be relevant to investors and stakeholders. So thank you very much for listening. I'm not sure if we have time for questions, but I will hand it over to you, Joy.
I think actually you just spent 25 minutes, very punctual. So I also saw, some questions related to that. Maybe Pratima, you can answer the questions here, right? Please.
Yes, definitely. Thank you, Joy. So I think one of the questions, we've answered most of them in the chats themselves, but one question that we thought we should take live was one that relates to financial modeling and corporate reporting on the TCFD. And the question was, considering climate change is long-term, while most financial models have a relatively shorter timeframe analysis, and fund managers struggle with the investment models not being able to reflect this risk. So what would be your advice over here, and how do we communicate this to investors? And this is a very relevant question because it's considered topical, and people are figuring out ways to deal with this time frame. And this is where I go back to the idea of where I said, you need to build those climate scenario analysis on a time horizon basis. What are your short-term, medium, and long-term risk assessments and opportunities with respect to climate? Because if that is not built in, it becomes very hard to do any sort of price discovery related to climate risks. And so, financial institutions are not going to be able to adequately price that, or they're going to ask for it at some point anyway, given the movement that TCFD is having within financial regulators. And so having that earlier built on and finding what the impact is. So, it's important to realize that on a short-term basis or even on a medium-term basis, if you've done the assessment, there actually may not be an impact. There might be an opportunity involved. So being able to talk about that translates much better into accounting and price discovery.
Thank you, Pratima, for answering these questions. And now we have been seeing that most of the questions have been addressed, and also some audiences asked if whether CDP can share this presentation together with us. And I also checked with Pratima, that's okay. And then we will share with the audiences after this workshop finished. So thank you again for providing this training session to the audiences. Thank you, Joseph and Pratima.
Thank you very much. Pleasure to be here.
Okay, so up to now, we have finished all the agenda related to this workshop today. It's very promising and very interactive discussions, both within the panels and also the training sessions. And we also received around 200 to 300 registrations of this workshop. And we see it's very promising and also, good anticipating to in the futures. So now we were going to end this workshop today. Thank you again for the audiences and our distinguished panelists, speakers, and trainers joining us today. Please let us know if you have any, suggestions or feedbacks related to this workshop. And I would like to share with you all our, contact information here on the screen again. You can approach us by our website or the linking pages as well. So again, thank you for all the audiences together with us and staying until now for over 2 hours already. The workshop will be ended here. We look forward to seeing all of you again in our future events. Thank you and bye.